As the U.S. markets are closed for the weekend, we are looking at the final figures from Friday, October 31st, 2025. Lumen Technologies, ticker LUMN, closed the session at $10.27 per share, down just 7 cents, or about 0.68%. In after-hours trading, it slipped a fraction more, sitting around $10.23. Now, if you just looked at that closing number, you would have missed the entire story. You'd think it was a boring, sleepy day for a telecom company. That assumption is the expectation. The reality is that Friday was one of the most violent, high-stakes battles between bulls and bears we've seen in this stock all year. The expectation was that after the company's third-quarter earnings report on Thursday night, the stock would collapse. And it did. It opened Friday morning and immediately fell off a cliff, plunging over 21% to a low of just $8.14. The bears were celebrating. It looked like the end of the recent rally. But then the script completely flipped. Buyers stepped in with immense force, and the stock staged a massive full-day reversal, climbing all the way back from $8.14 to close near its high at $10.27. This wasn't a drift, it was a war. And understanding why this war is being fought is the key to understanding Lumen. The common belief about Lumen, the one held by many who remember it as CenturyLink, is that it's a dying telephone company. They see it as a melting ice cube of old copper wires, saddled with an insurmountable mountain of debt, slowly bleeding out its legacy consumer and business customers. That's the expectation, and for years that expectation was pretty close to reality. The stock was left for dead, trading for just a few dollars. But the reality of what this company is becoming is now clashing directly with that old narrative, and it's creating the incredible volatility we just witnessed. The market is trying to decide if Lumen is a relic or if it's secretly one of the most vital picks and shovels plays for the entire artificial intelligence build-out. Let's look at the catalyst for Friday's chaos, the Q3 earnings report. On the surface, the numbers were, frankly, pretty good. The company posted an adjusted loss of 20 cents per share, which was a significant beat. Wall Street was expecting a worse loss, around 26 or 27 cents. Revenue also came in at $3.087 billion, beating the consensus estimate of $3.04 billion. So it was a double beat on earnings and revenue. This is where the confusion started. Despite the beat, the stock sold off 6% in after-hours trading on Thursday and collapsed at the open on Friday. Why? Because the bears weren't looking at the beats. They were looking at the year-over-year numbers. That $3.087 billion in revenue was still down 4.2% from the same quarter last year. The legacy mass market segment, the consumer side, was down a sharp 7.7%. The bear saw this and said, "See, the ice cube is still melting. The declines are continuing." Furthermore, management only reiterated its full-year guidance. It didn't raise it. In this market, if you don't raise guidance, you get punished. That was the expectation. But the reality of what happened during the trading day shows a different story. The stock traded an insane volume, nearly 50 million shares, which is more than double its 20 million share average. This wasn't retail panic. This was a systematic absorption of every share the panic sellers could throw. The bulls, the institutions, the smart friends you talk about over coffee about online investment ideas. They read past the headline revenue decline. They listened to the earnings call and focused on the new Lumen, the growth engine that is rapidly being built inside the shell of the old company. The narrative that won the day wasn't about the 7.7% decline in consumer. It was about the multi-billion-dollar pivot to AI. Here's the bull case that drove that $8.14 to $10.27 reversal. First, management is now positioning the company as the trusted network for AI. They are building what they call the backbone for the AI economy. This isn't just talk. In the earnings report, Lumen announced it had signed an additional $1 billion in deals for its Private Connectivity Fabric, or PCF, in the third quarter alone. This brings the total value of its PCF deals to over $10 billion. These are long-term contracts for massive data transport. Second, its Network as a Service, or NaaS, platform, which allows companies to buy high-speed connectivity like a cloud service, now has over 1,500 enterprise customers. They just expanded its reach to 10 million new business locations. And third, and this is a big one, they announced a new multi-year $200 million partnership with Palantir. Lumen will be using Palantir's AI platforms to boost its own services, a tangible sign that they are serious about this shift. This is why the market is so divided. The bulls are looking at the $10 billion in PCF contracts, the refinancing, and the insider buys from the CEO and CFO back in August, and the AI narrative, and it's saying that this stock is a key supplier to the AI boom, much like NVIDIA stock is for chips. They see a future where data-hungry AI models need Lumen's vast fiber network to function. They see the 82.5% year-to-date rally and believe it's just the beginning. The bears, meanwhile, are pointing to the balance sheet. And they have a point. This is the central conflict for Lumen. Its massive debt load. The company is operating in a high-interest rate environment, and it has tens of billions in obligations. This isn't a stock you can just buy in a Fidelity mutual fund and forget about. It's a high-wire act. But again, this is where the reality of management's actions is exceeding the expectation of imminent doom. The new leadership team, including CEO Kate Johnson and CFO Chris Stansberry, is not ignoring the debt. They are attacking it. Just last month, in September, they announced a major refinancing. They successfully repriced $2.4 billion in term loans, a move that saves them $24 million in annual interest payments. They also raised $425 million in new notes to redeem older, more expensive debt, saving an additional $10 million a year. This is the kind of smart, aggressive financial management that buys them the time they need for the AI pivot to work. They are also shedding the old company with the $5.75 billion sale of its consumer fiber business to AT&T expected to close in early 2026. This is a deliberate, painful, and necessary transformation. Sell the old, pay down debt, and invest everything in the new. This is a story that many who are just starting their self-investing journey on a platform like the Robinhood app might find confusing. It's not a simple, clean growth story like Apple stock. It's messy. It's a turnaround. It's a classic value play with a high degree of risk, the kind of stock that has seasoned traders at Interactive Brokers glued to their screens on a day like Friday. The battle is between the legacy assets, which are declining, and the new growth assets, which are rocketing. The question is whether the growth can ramp up faster than the legacy business fades. The Q3 report suggested the answer is yes. So what is Lumen Technologies? It's a telecommunications company. Yes, it owns one of the largest and most advanced fiber optic networks on the planet as a result of the merger between CenturyLink and Level 3. This network connects data centers, businesses, and cloud providers across the globe. For years, the market valued this as a dumb pipe, a utility. But the AI boom has suddenly made these pipes incredibly smart and valuable. The immense computational needs of AI require a new kind of network, one with extreme bandwidth and low latency, connecting AI corridors in data centers. Lumen is finding that it owns the irreplaceable real estate that this new economy is being built on. This brings us to the most fascinating part of the Lumen story, the great disconnect between Wall Street analysts and the market itself. The market, after its violent reversal, is valuing the stock at $10.27. The 52-week range is $3.01 to $11.32. This stock has more than tripled from its lows. And yet, if you look at the consensus analyst rating, it's a hold. The average one-year price target from these analysts is a stunningly low $5.41. This is not a typo. The professional analysts, the ones who provide investment help through big banks, believe the stock is worth half of its current trading price. This is the ultimate expectation versus reality. The expectation from the analysts is that the debt is too large and the legacy decline is too fast, and that the stock will eventually collapse back to the $5 level. The reality, at least what the 50 million shares traded on Friday suggests, is that the market believes the analysts are completely wrong. The market is looking at the $10 billion in PCF contracts, the successful refinancing, the insider buys from the CEO and CFO back in August, and the AI narrative, and it's paying $10 for that story. This is the kind of setup that makes a market. The stock is now a battleground for two completely different futures. Looking forward, the path for Lumen remains incredibly complex. The bulls need to see continued, massive growth in the growth segments. They need to see that $10 billion in PCF deals start to translate into actual recognized revenue, and more importantly,